Hello everyone. Now this is the second video in my series of videos where I am explaining how to read the option chain data and how to analyze and interpret the same. For those of you who haven't watched my first video, I would strongly advise to first watch that video and then come back to this video and resume watching it so that there is a continuity in concepts. I'm providing the link for the first video right up here. So you can click on that link and watch that video and then come back here and resume watching this. So without any further delay, let's begin. Well, before we get into the second part, let us first have a recap of what exactly we learned in the first part. Well, in the first part, we first learned where to find the option chain. That is, we now know that the option chain we can find out by visiting the website of nseindia.com. And then in the first part of the video, we saw the various headings and columns that appear in the option chain analysis. And then we saw how open interest is calculated. Then we learned how the volume is calculated. And finally, we learned how the change in open interest is calculated. Now, in this second part of the video, we are going to learn what exactly does the option chain data tell you? What is the story that you can extract from that table, right? What are the things that you should notice? What are the things that you should focus on? Is exactly what we are going to learn in today's session. Now, if I were to categorize it broadly, I would say that the things that we are going to learn from this option chain data analysis is learning how to find out the buyer and seller sentiments, then learning how to find out the support and resistance level. I'll get to this in a little bit of detail in a few moments. Then we can learn how to find the direction of the market, and we can learn when to enter and when to book profits. But predominantly in today's session, I am going to focus on the support and resistance level, because once we know this, understand, we can easily determine when to enter and when to book profits. Now, what exactly do we mean by resistance and support? See, if I were to plot the price movement of a share on a piece of paper, the chart would look something like this. We draw this line. This line is called as the support line. And this line which we have drawn here is what we call as the resistance line. Now, why are they called the support and the resistance line? See, if you look at these price points here, you will notice that the share price has touched here and it has tried to break this level, but it has not been able to break it on two occasions, right? That means that the share is finding its support at this price. It is not able to break the support level. And similarly, if you look at the upside, you will notice that the share price has touched this point and then it has again tried touching this point, but it has not been able to break this point. That means the share price is finding a resistance at this level. So these are called as the support and resistance level. To define it in a simple language, I would say support level is the level below which the share is temporarily not able to go, and the resistance level is the level above which the share is not temporarily able to go. See, I'm using the word temporary because this situation may not last forever. You may find that at a particular point, the share price is either broken the support level or it has broken the resistance level, right? So understand this. The bottom, the line which gives support to the share price is called as the support line, and the line which is resisting the movement of the share price upward is called as the resistance line. Now in today's video, we are going to focus here because once you know the support line and the resistance line, remember, as a trader, it becomes very easy for you to take positions, because if the share price is here, that means it is near its support level. And if you think that it is not likely to break the support level, then you can take a position here. That is, you can buy the shares here so that when it goes up and it reaches somewhere at this point, you know that the share is facing resistance at this point. That means it finds it difficult to break this. That means you can sell it here. So every time when the share is touching its support level, there is a potential for the trader to buy it. For example, here again, the share is at the support level. So you can buy it here and maybe sell it here. So once we know the support and the resistance level, it becomes very easy for a trader to take position. Now the question is, how can we look at the option chain data and try to figure out where exactly is the support level and where is the resistance level? Like I mentioned, it is important for a trader to know the support and the resistance level, because he would be indulging in buy at the support level and sell at the resistance level. That's how you would make profit: buy low, sell high. Now, if you remember the last video, that is the part 1, we had discussed that when you look at the option chain table, you would find one portion which is shaded, that is this portion, and another portion which is not shaded, that is the white portion, right? And we now know that the shaded portion is the in the money option, and the non-shaded portion, that is the white portion, is out of the money option. Similarly, for a put, the white portion here is the out of the money option and the shaded portion is the in the money option. Now, this was some point which I had mentioned in the first video also, and I'm mentioning it here also, that people who are watching this video, I presume that they have certain basic and preliminary understanding of the concept of options, right? I am not explaining the basics of options here, because understand, here what we are discussing is how to study and analyze option chain data. So the underlying presumption is that you know certain things about options. Now, one of the things that you would know about options is that when the option is in the money, it will be expensive, because an in the money option will have both intrinsic value and time value. Whereas an out of the money option will be cheaper as compared to ITM option, because an OTM option only has time value. It has no intrinsic value. If I were a buyer, then given a choice, I would rather prefer to trade in OTM, because it is cheaper to trade in OTM option rather than trading in the money option. And trading in out of the money option gives me a better volatility and therefore provides me with a probability of higher returns, which is why bulk of the people you would find are trading in the OTM options. Very few people trade in the money option. I will discuss this in a little more detail here. See, like I mentioned, people always prefer to play in OTM options. That is because they are cheaper, they have a higher volatility, and because they are cheaper and have higher volatility, they provide you with a higher return as compared to playing in the money option. I mean, think of it from the trader's point of view. If I were to buy something expensive, and that would give me a lower rate of return on my investment as compared to if I were to trade in something cheaper and which would give me a higher return, then obviously I would go for the cheaper stuff, right? So therefore, people always tend to prefer in playing in OTM option. That is where the action of the market lies. That is where the crowd lies. And therefore, when we are looking at option data table, we will be focusing only on the OTM section, that is the white portion, the non-shaded portion. We will not be looking at ITM. Well, of course, as a trader, you must keep a watch on in the ITM options also, but then your main concentration and main focus should be on the OTM part. That is where the action is. That is where the buyers and sellers are right now focusing their activity. And remember, people drive the market. The market doesn't drive the people. It is people who drive the market. That means you need to know where people are. And people, like I just mentioned, they're not at in the money option. They are at out of the money option. So our focus and concentration is going to be in the out of money portion of the table. Now, although I did mention that I would not be getting into the basics of options, but still, before we get into the next section, that is where we will be actually be looking at the NSE option chain data and trying to figure out the support and the resistance level, there is a certain basic thing which I need to discuss. This is regarding the intrinsic value and the time value. See, we all know that when we are talking about an option, it can either be in the money, it can be at the money, or it can be out of the money. And all the options, they comprise of two parts: intrinsic value and time value. Now, as far as in the money option goes, it will have an intrinsic value and it will have a time value, and that is why an in the money option is always going to be very expensive. Whereas an ATM and OTM option will not have any intrinsic value, but they are all going to have time value, which means all options, whether it is in the money, at the money, or out of the money, will have time value. And remember, time value erodes with time. That is, with every passing day, the time value in the option will fall. Which means if you are a buyer of an option and the price of the share doesn't move, the price of the underlying doesn't move at all, it remains flat, even then you will suffer a loss every day, because remember, every day the time value will reduce marginally. And ultimately what will happen is that on the expiry date, whether the option is in the money, at the money, or out of the money, there will be no time value, because remember, the option is already expiring. So where's the question of time value? So it will not have time value. Yes, if the option on the expiry date, if the option is expiring in the money, then it will definitely have intrinsic value. But remember, ATM and OTM option will have no intrinsic value as well, which means on expiry, if the option expires at the money or out of the money, its value will be zero, because remember, it has no intrinsic value, it has no time value. That means it will trade at zero. Whereas an in the money option, on the expiry date, will have intrinsic value. It will trade at the intrinsic value. Now, this time value, which decays over time, the decay is slower towards the beginning, but as the option nears its maturity, the erosion or the decay will become faster. So if I were to plot this decay on a graph paper, it will be something like this. It will decay slowly at the beginning, but as the option is nearing maturity, the decay will become extremely fast, because remember, on maturity, this line has to touch to zero. This is time value. Remember, I told you on expiry, the time value has to be zero, right? So as the option nears expiry, it will touch zero and the decay will become much faster. Now just imagine, if you are a buyer and you are holding an option, then whether the share price moves or not, that is a different story altogether. Whether the share price moves or not, there is some element of loss that you are going to incur on account of loss of time value. Now, of course, if the movement of shares in your favor is much higher than the loss in time value, you will stand to make a profit. But if the share price doesn't move at all, still you will make a loss, because the time value erosion will be there. Which means the time value is the worst enemy of the buyer and it is the best friend of the seller. Because remember, a seller who has sold an option, let us say a seller has sold an option at say 10 rupees, and this purely consists of time value. Then every day, remember, this value is going to reduce. Finally, it is going to come to zero. Now, if I'm a seller and I have sold this option, or I've sold any asset, and if the value of the asset is coming down, then remember, I stand to make a profit, because I've sold at a higher level and will be buying it back at a lower level. That is why we say that the time value is the option buyer's worst enemy and the seller's best friend. I'll just take you to the next slide where we'll discuss this. Time value decays over time. Now, this is exactly what we discussed right now. Option value erodes over time. Now, this is because of the time value. Erosion is faster towards the end. Now, understand, when I'm talking about option value, I'm actually, okay, let me just change this. This is not option value I'm talking about. This is time value. So time value erodes over time and erosion is faster towards the end, and time value is the best friend of the seller and the worst enemy of the buyer. So now we have discussed the basic concept of intrinsic and time value to the extent I require it for my further discussions. Now let us look at this data chain. Now obviously, as you can see, this is from the NSE side, and on this day when I have taken, if you notice, the ATM option is here, is somewhere at this point. Now if I remember right, on this day the Nifty was trading at 11,890. So that is somewhere between 11,850 and 900. So it was trading in between, and that is why you see that At this point, the option is ATM. As far as calls are concerned, this is the in the money portion. This is the out of the money portion. And as far as put is concerned, this is out of the money and this is in the money. I had just mentioned that given a choice, a buyer or seller would always trade in OTM option. And this is where actually bulk of the trading happens. Let us understand why the bulk of the trading happens. Because if you remember, I mentioned that the rate of return when you trade in an out of the money option is much higher. The volatility is much higher. Let us actually look at it. Let us say a trader is given a choice that he can buy 11,700 call. Remember, this is a call. And also, please bear in mind that Nifty on this date is 11,890. The spot Nifty is 11,890. The trader is given a choice that he can buy 11,700 call, or alternatively, he can buy a 12,100 call. And if you see, this 12,100 call is an OTM call and it is trading at a premium of 9.10. Remember, OTM options would have a very low premium. And this 11,700 call is trading at an option premium of 201.05. Now, let us say we give the trader an option that he can either buy the 11,700 call or he can buy the 12,100. Now, let us see what happens under each of the circumstances. Now, let's say he buys the 11,700 call. And remember, this 11,700 call is in the money option. And he buys it by paying a premium of 201. Now, the market price of Nifty on expiry, I have taken three simulated situations that maybe on expiry, the Nifty ends up at 11,890, or it ends up at 11,500, or it ends up at 12,200. Now, let us analyze what happens under each of the three situations. First, if the Nifty ends up at 11,890, remember this guy has got a right to buy at 11,700 and Nifty is 11,890. That means this option is expiring in the money. And therefore, on the last day, it will be trading at the intrinsic value. Now, remember, the intrinsic value is 190. Now, how did we derive this intrinsic value? Right to buy at 11,700 and the market is 11,890. So, 11,890 minus 11,700. That is 190. That's your intrinsic value. Therefore, the option which the buyer had purchased at 201 is now trading at 190, meaning he's incurred a loss of 11 rupees. And therefore, his return on investment is a negative 5.48%. Now, how did I derive this return on investment? It is basically what he has generated, that is negative 11 on his investment of 201. So essentially, this is 11 by 201. But remember, this is negative. And also remember that is total premium outlay. Now, we all know that Nifty trades in lots of 75. Now, if the premium is 201 per option, then the total premium outlay would be 201 into 75, that is 15,075, which means his loss in this case would be 75 units into 11 rupees. That would be his loss. But I'm not computing the total loss, I'm just computing the per unit loss. Okay. Now, supposing the market expires at 11,500. Remember, this guy has got a right to buy at 11,700. So his option is out of the money. I mean, right to buy at 11,700 when the market is trading at 11,500 is obviously out of the money. In which case, this option will be trading at 0. So the option which the buyer had purchased at 201 is now worth 0. Which means he has lost his entire 201. That means his return on investment is negative 100%. He has lost 100% of his investment. That means he has lost total premium 15,075. Let's look at the third situation. Suppose the Nifty on expiry is trading at 12,200 and he's got a right to buy at 11,700. That means the option is now in the money, which means it will be trading at the intrinsic value. That is 500. Now, how did I derive this intrinsic value? 12,200 minus 11,700. That's my intrinsic value. Which means the option which he purchased it at 201 is now worth 500. That means he's making a profit of 299 on his investment of 201, which gives us a ROI of 148.76%. Now, this is the situation where the trader buys an in the money option. That is, he buys the in the money option by paying a hefty premium. Let us look at the alternative course that he could have taken. Now, alternatively, instead of buying 11,700 call, he could have purchased the 12,100 call, which is an out of the money option right now. So let us see what happens now. See, he would purchase the 12,100 call, which right now is out of the money. Therefore, it is trading at a low premium. So this guy pays a premium of 9.10. If the Nifty on expiry happens to be 11,890, then remember his right to buy at 12,100 will be out of the money, and therefore it will be trading at zero, which means that he has lost the entire premium that he has paid. That is, his loss is 100% negative, and total premium outlay, because we know that it's traded in lots of 75, so 75 into 9.10, he would have lost just 682.5. Whereas if you look here, if he loses 100%, he stands to lose 15,075. If the Nifty on expiry date is 11,500, again he's got a right to buy it at 12,100, so the option will be out of the money. It will be trading at zero, so he's lost his entire premium, that is 9.10. So his return on investment is a negative 100%. Again, he lost only 682.5. But this is where something interesting happens. Suppose the Nifty expires at 12,200. Remember, he's got a right to buy at 12,100. That means this option is now in the money, which means it will be trading at its intrinsic value on expiry, and intrinsic value is 100, and 100 is nothing but 12,200 minus 12,100. So the option which he purchased for 9.10 is now worth 100 rupees, which means his profit or loss is 90 rupees 90 paise. 90 rupees 90 paise on investment of 91. Can you look at the return on investment here? 998.10, and his total premium outlay was only 682.5. That means here you have a scenario where if he loses, he's going to lose a small amount, but if he makes money, he's going to make a return on investment of something as weird as 998.10%. So that is why option buyers tend to prefer to trade in out of the money options, because it is cheaper for them and it provides a higher volatility and higher return. And for sellers, remember, out of the money option comprises entirely of time value. And I mentioned time value is option seller's best friend. So obviously the seller would want to be located where his best friend is there, no? That means the seller will always also be located at the out of the money zone, that is the non-shaded portion. And the buyer will also be located in the non-shaded zone, which means the buyer and sellers tend to collect at one zone, that is the out of the money zone, which is why I told you that we need to focus in the out of the money region. That is where the action happens. Hence, to summarize what we discussed, we can say that the entire action, or if not entire, the bulk of the action is focused in the OTM segment. Therefore, the OTM part is where we need to focus, because that is where the buyers and the sellers both are focusing their activity on. So that is where the market is. Remember, people drive the market. That is, the market is driven by people. Unlike what most people think that, market drives people. No, people drive the market. So wherever people collect, that is where the market would also tend to focus its activity on. So if there are a lot of buyers and they are buying, then remember the market moves. So it is the buyer who are moving the market. Similarly, it will be the sellers who will be moving the market. So please remember that people drive the market. So that means the market activity will be focused where people congregate or people collect together. Now we have seen that buyers would tend to collect in the OTM zone, and sellers would also tend to collect in the OTM zone. Right? So this is where the action is, and this is where we are going to focus on. So when you look at the option table, option chain table, remember we are going to focus in the OTM part, that is the white non-shaded part. Please keep this in mind. This is important. But now the next question is, we know that we need to focus on the OTM part, but then OTM part itself has a lot of data. The question now is, where exactly to concentrate? Well, to explain that, have a look at this picture. Now, this is the picture of a railway platform, and there are a lot of people who are standing on this side, and there is one person standing on this side. Okay. Now, let us say you are a stranger to this town and you don't know where exactly the train is going to come. And if you were to take a chance, or if you were to place a bet as to where the train is going to come, that is whether the train is going to come on this platform or whether it is going to come on this platform, where would you place your bet? Obviously here. Why here? Because a lot of people are here, and out of these lot of people, some of them could be regular daily commuters who exactly know what is going to happen. Right? That means these are well-informed people. Now, out of this crowd, some of them would be well-informed investors. So obviously, if you were to take a chance, you would take a chance here, which means when you are looking at the option chain table, you will be focusing on the OTM section, and within the OTM section, you will now see where exactly is the highest open interest being formed. Because remember, what do you mean by open interest? Open interest means that many people have got their position open, and that many people are now interested in knowing what is going to happen to the market because they have kept their position open. Now, if you look at this platform, there are so many people with open interest. They're all wanting to catch the train. But if you look at this person here, he's not interested here. He is looking somewhere here. That means he doesn't have an open interest possibly. Which means as a trader, you will want to see where the maximum number of people have got their open interest, because that is where the activity is going to happen. And that tells you to a reasonable extent that what is expected to happen. Now, I'll tell you another thing. Supposing, now even if you look at this platform, you can reasonably estimate that the train is going to come on this platform. But looking at this picture, can you tell whether the train is going to come from this direction or whether the train is going to come from this direction? Possibly you can't. But if this photo had clearly shown a lot of people looking that side, then you could have reasonably this side, then you could have reasonably estimated that the train is going to come from this side. That is why people are looking there. Right? So that means when you look at open interest, you should be able to estimate that this is where the market is focusing on. This is where the action is going to be. The next step that we are going to do is that we will look into the option chain data. We will focus on the OTM part because we know that is where the crowd is. And then we will subsequently learn how to know which direction the market might move. What we learned just now, we should focus where open interest is high. How would you find where the open interest is high? Simple. Option chain data. Remember, there is a column where the open interest is given. I'm not talking about change in open interest. I'm talking about the open interest, which the column which indicates how much open interest is there in the market. Now, when we look at the open interest column, let's say you find that the open interest is 25 lakh, 30,200 something. This is my open interest. But now the question is, what exactly can you decipher from this data? This tells you that so many buyers have got open position or so many sellers have. For us, what is important is realizing the fact that so many sellers have. We have to focus on the seller. Now, why is that? Now, this is very critical. Listen to me very carefully. See, an option buyer is a person who will suffer only limited loss to the extent of premium, whereas an option seller can suffer unlimited losses. Because the risk of the option seller is very high, the brokerages charge a very high margin to the seller, right? Which means these sellers, they are not ordinary retail individual. Most likely they are high net worth individual or institutions. Because remember, it is only these two category of people who will have the capacity to bear unlimited losses. This buyer is more often than not a retail player who's got the capacity to only suffer limited losses. Now, since these are HNIs and institutions, remember, these people are seasoned traders. And more often than not, they have access to privileged information. They are more knowledgeable. And if as a trader you want to take a position, do you want to be on the side of, do you want to be analyzing what this guy is thinking, or do you want to be analyzing what this guy is thinking? Obviously, I would want to know what this guy is thinking because he's the one who's going to drive the market, right? So whenever we look at the option chain data, we'll be looking at the data, but we will start thinking as a seller, what exactly is he doing, right? What is his thinking? Because remember, once we analyze his thinking, we know we can reasonably forecast the market because these are the guys who drive the market. Let's have a look at the table. Now, let us say we know that Nifty on this day was 11 890, right? So the at the money point was somewhere here. Now first, let us look at calls and let us see where the open interest is maximum. See, I have marked this. This is the place where it is maximum, right? 45 lakh 95,000, which means there are a lot of buyers and sellers here. But understand, I don't care about the buyer. I care about the fact that there are a lot of sellers here. And lot of sellers here means what? See, when you buy a call, you are expecting the market to go up because buying a call is a bullish strategy. When you are selling a call, you are expecting that the market will not go beyond this level because there are a lot of sellers here, no? So all these sellers are thinking that the market will not go beyond 12,000. That means this 12,000 forms the resistance line. A lot of sellers saying that the market will not go beyond 12,000. And remember, sellers are knowledgeable people. They know what is happening, right? And similarly, now let's look at the put zone. And in put zone, let us see where the maximum open interest is. I can see the maximum open interest 34 and maybe 36 here. That is 11,711. Now understand, when you are buying a put, your view is that the market will go down. Remember, buying a put is bearish. But when you're selling a put, you feel that the market will definitely be above 11,700. It will not go below 11,700, right? That means, remember, if the number of open interest here is very high, that means there are a lot of sellers here. Buyers are there. But like I said, I don't care about the buyers. I care about the fact that the sellers are there. And so many sellers are of the view that the market will not go below 11,700. That means I can reasonably take this to be the support level. Now, did you notice something? We have derived the support and the resistance level. Right? Now, in the graph, we knew that the line which was at the bottom, this is the support level. And the line which was at the top, this is the resistance level. Now, here we can clearly see that the resistance is somewhere at 45, maybe 12,000. And the support is at 11,700. So we can reasonably form a view that for this particular day, the Nifty will find its support at 11,700 level and it will find a resistance at 12,000 level. Now, let us again go back to the OTM call and see where is the next highest volume happening at. See, this is 45 lakhs. The next highest volume is happening at 3192 and this is at 12,100. That means I can reasonably say now that if the market breaks out from this resistance level, it will face its next resistance at 12,100. Meaning, if the market moves out of this zone, it will face its next resistance at 12,100. I mean, you would have often watched technical analysts mentioning this on television, no? Where they say that the stock has got a resistance level of say 5,000 and if it breaks that resistance, it will find its next resistance at 5,500. Or they say that the share has a support level of 400, but if this support is broken, then its next support is at 300. This is exactly how they do it. And if you notice, let's look at the put out of the money. Where is the next highest volume happening? Well, the next highest volume is, I'm not concerned about this 34, 39 because this is too close to 11,890. The next is possibly here and this is too far. This is 11,500. This is too far. Possibly this. That means at 11,650. So I can possibly say that it has got a support at 11,700 and if it breaks this down, possibly it will have its next support at 11,650. Right? Now, if you realize that from all this discussion today, we have suddenly learned how to look at the option table and find out the support and the resistance level. Now, why do you think this is important? Now, this is something that I mentioned that a trader would always want to buy at the support level and sell at the resistance level. But to do that, he first needs to know the support and the resistance level. And this is exactly what we have learned just now. Now, that is all for today's session. In the next session, I will be discussing as to how to interpret the data about change in open interest and volumes to try to forecast in which direction the market is likely to move. So in part 1, we saw how to calculate open interest and how volumes are calculated and how change in open interest are calculated. And in part 2, that is today's video, we have learned how to calculate the support and resistance level, and therefore that can tell a trader when to buy and when to sell. So keep watching this series of videos. And if you have not still subscribed to my channel, please do subscribe to my channel and hit the bell icon so that you get notified whenever I upload a content and you don't miss out on any important videos. So that's all for today. Stay fit, stay healthy, and cheer.